Greetings from Three Edge Asset Management. My name is Fritz Folts, and I'm the Chief Investment Strategist here at Three Edge, and I'm pleased to be joined here this afternoon by Steve Cucchiaro. Steve is the President and the Chief Investment Officer here at Three Edge. Steve and I have made a series of videos recently, and this one is intended for those registered investment advisory and wealth management firms that we know and that we work with. And we're going to be discussing how our three-edge conservative strategy can serve as a substitute or a complement to bond portfolios. So let's get started. And Steve, the bond market, we talk a lot about how the equity markets have gone through a lot of volatility, but the bond markets are at just about all-time lows now, or just off of those. And clients are wondering, how do bond portfolios fit in terms of client allocations at this point? So maybe could you just bring us up to speed as to where we are now in the fixed income markets and how we got there?
Yes. So Fritz, we have been in an historic bull market in bonds ever since September of 1981. And this has led to the perfect environment to be a bond investor where you could lock in higher yields and where the principal value of your bond appreciated. Because most investors' experience just goes back 39 years or less, it seems like that's the way it always was, but that's not the case. Bond yields peaked in September 1991 over 15%, and they kept going up until there was an extraordinary monetary tightening when the Fed came in and did extraordinary tightening, and that was a turning point. Right now, we're at the mirror image of what happened in September of 1981. Now we've got all-time record low bond yields this month in March of 2020. And we just had an extraordinary, unprecedented monetary action, this time in the opposite direction, a monetary easing that you could call QE infinity. It's the Fed saying that they will have unlimited amount of money that they can print. So we see this as a major turning point, and this could be the era where bonds no longer play that role of being a safe source of income and appreciating.
Right. So before, we counted on our bonds to tamp down the volatility of the equities that we held and to provide higher income than equities.
That's right. If you think about that, you have a situation now where you have very low interest income from the bonds. And just as a reminder, if you own a bond with a duration of 10, that means that if interest rates go up just 1%, that bond you own loses 10% of its value. So bonds are no longer a safe source of income.
Great. So let's go on to the next part and talk about our conservative strategy, the three-edge conservative strategy, and how what could be in that strategy and how it can work to substitute or complement clients' bond portfolios over the next 1, 2, 3, 5 years.
So if we think about the original idea behind conservative, it was to build a portfolio that could withstand the widest variety of economic, market conditions, shocks, etc. And to do that, we've stress tested that portfolio going back 140 years. We've studied intensely every bear market that's happened since the late 1800s. And the big lesson is that bonds can be your best hedge in certain environments, but not work well at all in other environments. And that each environment benefits a certain hedge. A different hedge might work in different environments. So for instance, when inflation and interest rates are coming down, which we've seen since September of 1981, bonds could be an excellent hedge because while you're investing in bonds, they're creating wealth. You're making a real return, real meaning inflation-adjusted return over time. However, if you go back before 1981, you had a very, very different environment. From the mid-40s to the early 80s, you had the opposite happen. You had interest rates go up, you had inflation go up, and measured against inflation, or as a measure of real wealth, you actually lost money in the bond market. And that was especially true in the 1970s. Even during this period, municipal bonds, which people think of as very safe investments, some of them lost 20% of their portfolio value. And if you did hold them to maturity, the dollars you got back were not worth the dollars you put in. So bonds are not always the best place to be. Now, if you have a credit contraction or credit crunch, like we had in the early 1980s, like we had, frankly, earlier this month, March of 2020, then bonds do poorly, stocks do poorly, commodities do poorly, but cash is king. And cash is your safe hedge, much better than the others. Now, if you have in the past and in the present extraordinary monetary stimulus, which can create negative real or inflation adjusted interest rates, weakening currencies, and or inflation, those are environments that are excellent for gold, and gold is your best hedge. And this was true in the 1970s, this was true in the decade of the 2000s, and we believe this is true now and going forward.
Right.
And then finally, you can have a bull market where the hedges don't always do so well, but by having a limited constrained amount in equities, you can more than make up for any losses you might have in your hedges. So our whole idea is to have a highly diversified portfolio aiming for very low volatility, very low drawdown, but that can be flexible and adjust the right hedge given the right economic circumstances or market circumstances. And we think we're at a historic turning point right now where bonds have been one of the greatest hedges for the last 39 years, and those days are over.
Great. Thanks for that, Steve. Really appreciate it. For additional information about the 3-Edge conservative strategy or our other strategies, the best place to start is at our website, and that's at 3edgeam.com. So thank you for listening, and Steve, thanks for the insights. Appreciate it.